In this video, we're going to cover the basics of options trading. This is Options 101. So if you're completely new to option trading, this is the video for you. First, we're going to cover the two types of options. We're going to talk about calls and puts, and then we're going to go over the risks and rewards of either buying or shorting calls or puts. So if that sounds like something you're interested in learning, please hit the like and subscribe buttons, and we'll see you back right after the intro. All right, so for this video, I'm going to assume that you are completely new to options. We're going to start right from the basics. So when we talk about options, there are two basic types, calls and puts. So let's start off with what the definition of each of those are. So let's start with call options. A call option gives the holder the right, but not the obligation, to purchase shares in a given stock at a predetermined price up to the expiry date. Now, put options, on the other hand, give the holder the right, but not the obligation, to sell shares of a given company at a predetermined price up to an expiry date. Now, I know this sounds confusing if you're hearing it for the first time, but really it's not. So, let me give you an analogy that hopefully will help. Let's say you're buying a house and you found a house that you really like. Now, this isn't the perfect scenario, but it's a close enough analogy that it really should help you understand how calls work. So let's say you agree on a price of, let's just pick $250,000 to purchase this house. Also, let's say you agree to have a closing date within 90 days of making this agreement. So typically what you do at this point to show your intent to purchase the house or to show that you're serious in buying the house, you would give the owner a deposit. So let's say in this case you're giving a $5,000 deposit. Well, to compare this to call options, the $250,000 purchase price, that would be your option strike price. The 90 days, that's how much time you have until the option expires. And the $5,000 deposit, that's the cost that you paid for that option. So basically, paying that $5,000 gives you the right, but as we'll see, not the obligation, to purchase that house for $250,000 up to that expiry date of 90 days. So during this time, the owner is not able to sell that house to anyone else except you, and he must hold it for you for that period of 90 days until expiry. But let's say at some point prior to those 90 days, there's a major housing crash. And now you believe that that house is no longer worth 250,000. Maybe it's only worth $200,000 now. So why would you buy a house, so overvalued? Well, again, you have the right but not the obligation to buy that house. You're free to make that choice. However, if you don't buy that house, you're going to lose that $5,000 deposit. Well, that's very similar to how options work. When an option expires, if it's out of the money, you basically lose whatever premium you paid for that option. That money's gone. So we can see that stock call options work very similar to this analogy of purchasing a house with one major difference. So, like we said, the principle behind it, the contract, the strike price, the expiry dates, those are all the same. However, the value of an option in the stock market is not fixed like it is in the example of, giving a deposit for a house of a fixed amount of $5,000. The value of a call option is constantly changing. And the reason for that is you can sell your option at any time prior to expiry to another person. So think of it this way, you're basically, if you sell your call option, you are transferring that right to buy those shares to somebody else. Well, you can't do that with a house. I mean, if you put a deposit down on a house, you can't transfer that right to somebody else to buy the house, at least not with, some type of negotiation with the owner. It's not a simple sale of that call option. Whereas in the stock market, it is. You basically sell that call option to somebody else, and that person now has the right, but not the obligation to buy those shares again prior to that same expiry date. So you might be asking at this point, well, why even trade options? Why not just buy the stock or, short stock if you think the market's going to be going down? Why even, what's the benefit of trading options? Well, there's quite a few reasons why you might want to trade options. But some of those get pretty complicated. So I'll start with the two most basic reasons people want to trade options. The first is leverage, and that's probably the most common reason. When you trade options, you get the equivalent of a large number of shares for a relatively low cost. It gives you a lot of leverage in the market. Of course, that leverage can work in your favor if the stock moves the way you think it's going to move. It can also work against you if the stock moves, in the wrong direction. Second most common reason that people trade options is as a hedge. Basically, a way to get insurance on an existing stock position that you already own. So now let's look at how options are priced. So we mentioned that, option prices change by the minute. What affects the price of that option? Well, in stock options, there's really three primary things that go into determining the price. The first one is the intrinsic value. So that basically means the difference between the current stock price and the strike price of your option. So, in other words, is your option in the money, out of the money, at the money? That will have a pretty big impact on what the price of that option is. So, for example, if you buy an option that's out of the money and the stock price moves in your favor to where now your stock price is in the money, you're going to have a big gain or a big change in price, big profit in that stock option. Second factor that goes into determining the price of a stock is the time value. Remember, we talked about an expiry date. Once the expiry date occurs, that option is worthless. So, if you think about it from that perspective, the more time that exists in an option, the more time value that there is, and therefore the more expensive the option. So, in other words, if you're buying an option that's 3 months out versus an option that's 3 weeks out, the one that's 3 months out, even at the same strike price, is going to be significantly more expensive because you have a lot more time until expiry. Now, one thing to note is that time decay occurs every single day. So at the end of every trading day, that option will lose some value as a day has gone by. But that relationship is not linear. As you get closer to the expiry date, the time decay gets a lot faster. So keep that in mind. And the third thing that goes into option pricing is the implied volatility. The higher the implied volatility of the stock, the more expensive the option. So that's something that you can look at when you're doing your technical analysis is look at what is the implied volatility of your stock. If the implied volatility is going up, that means option prices are going to continue to rise. Whereas if the implied volatility is dropping, like say after an earnings event, then the cost of your option is also going to drop. So hopefully now you have a better understanding of what calls and puts are and also what affects the price of those options. So let's look at some ways to trade them. So I mentioned at the start of the video, you can either buy or sell options. In other words, you can go long or you can short an option, just like you can with a stock. And that goes for both calls and puts. So this can get a little complicated, and you really need to think about what it means if you're selling versus buying an option. When you buy an option, so let's start with calls again. When you buy a call, you pay a premium, and you are anticipating that the stock price is going to go up in value. When the stock price goes up in value, your call option will go up in value, and you can sell your call at a higher price. Now, on the flip side of that, you can also short a call. So you can do what's called sell to open. And what happens then is now instead of paying a premium, you're actually collecting the premium from someone else. Okay, someone else is buying that call option. Someone else is buying the right to purchase those shares. You are selling them that right. So you're collecting the premium. Now, if you own the shares of that stock, this is called a covered call because if the stock price moves against you or moves up above your strike price, you own the shares and you are able to sell those shares to somebody else. If you don't own the shares, then it's called selling a naked call. Now, this is very risky, and I definitely would not recommend naked calls for beginner traders. And we can talk about some of those strategies a little later on here in the video also. Now, moving on to puts, just like with calls, you can buy to open a put. So, in other words, you're going long the put. And again, in this case, you pay a premium, but this time you're anticipating the stock price to go down. Because remember, puts give you the option to sell, or sorry, puts give you the right to sell a stock at a given price. So you want to be able to sell it at a higher price than where the stock is at expiry. So you want the price to go down. That makes the value of the put option go up. Conversely, you can sell to open your put. And again, that's shorting a put. In this case, just like for the call, you receive a premium because somebody else is buying that put. You receive a premium, and someone else is getting the right to sell those shares, meaning you would have to buy them. So again, selling naked puts is risky. It's maybe not quite as risky as selling naked calls, but it still obligates you to buy those shares at a predetermined price at some point down the road. So if that stock has a huge correction and is now way lower than what that strike price is, you still need to buy the stock up at that high strike price. So again, shorting any kind of option, puts or calls, is very risky, and I wouldn't recommend that as a beginner strategy. All right, so we went over a lot of information in this video, but how do we really put it to use now? Well, there's a couple ways you could look at this. I mean, hopefully now you understand what the difference between calls and puts are, what affects the price, and most importantly, what the difference is between buying an option and selling an option. Now, a common beginner mistake when someone watches a video like this is they think, okay, well, the easiest strategy or the best strategy is let's just buy calls. So you'll find a stock where you think the price is going to increase, and you buy a call. You buy a naked call and hope for the price to go up. And I'll be honest, that's not one of the better option strategies. It does put you at quite a bit of risk because, again, remember, at that expiry date, your option is worthless. So it may seem like a really good deal. You're getting a lot of leverage, you're getting the equivalent of a large number of shares for a pretty low cost, but you got to understand. You're not only now trying to predict the direction of the stock, you're also trying to predict a time frame. So, for example, if you're looking at a stock and you think it's going to go up by $5, you're saying it's going to go up by $5 in the next, X number of days, whatever that expiry is. So it's a lot different than actually buying the stock and having more time for that stock to, say trade sideways, consolidate a bit more before it finally breaks out and continues higher. So there is, a different element of risk when you're trading options. So here's what I would recommend. Now that you understand the basics of options trading, I'm going to post a link here. Watch this video. It's called Ultimate Stock Option Strategy Video. In that video, I go over 3 very simple, very easy to implement option strategies that you can use in different scenarios. And those option strategies are way more effective. They're still really simple to use. I would call them, beginner type strategies, but they're way more effective than just, buying a naked call or selling a naked call, or, or same thing with puts. So anyway, that's all I have for this video. Hopefully that was really helpful. Hopefully that gives you a good base that you can build from now that you understand what options are and what goes into the pricing of options. And like I said, I would recommend watching the Ultimate Stock Option Strategy video to begin with. I do have a few more advanced type option strategy videos that you can watch, but I would stick with that one first. Learn those 3 basic strategies and then go from there. Hopefully this video was helpful. If you're enjoying this content, please hit the like and subscribe buttons, and we'll see you next time.